Good morning. Welcome to Trading Hour. It's a Friday morning. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Rima. With me is Vivek Iyer. The Sensex has surged 1,200 points. The Nifty is above 22,800 as India participates in the relief rally after US suspends the 26% tariff on India by 90 days. The biggest sectoral winner today is metals. The Nifty Metal Index is up more than 3%, 3.5% as the dollar index has cracked sharply. But other sectors too are higher, whether it's pharma, whether it's auto, it's defense. IT too is largely up in the green, up 1.5%. But that said, there's so much to track today. You've got the AMFI numbers, so we'll get a sense of the investor sentiment, though March was a month of a rebound after the weak month of February. Then you've got the US PPI later. Back home in India, you've got the March inflation number and the February IIP number. So there's lots to track, even as we head into the long weekend. Data heavy day.
March, one thing we have to keep in mind is, especially when it comes to AMFI, number one will be the SIP number, like you mentioned. Number two, March, generally you see higher ULIP entries coming in. So it needs to be seen whether April, there's any month-on-month moderation or whether it sustains. So that will be one important thing to track. But overall, we'll look at what exactly is transpiring as far as markets are concerned. First up, you spoke about the metal index, clearly the top gainer there. But look at the pharma pack. It's been a very sharp rebound. A lot of positive news flow too that's come in over the weekend. So names like Sun Pharma, names like Cipla, Biocon, these three stocks have seen positive news flow gaining significantly in trade. Along with that, other generics like Granules, Laurus Labs, all of these stocks doing very well. Agriculture, chemical stocks and agrochem stocks, these were the stocks that were beaten down the most on account of higher tariffs, but they've all seen a relief rally today. PI Industries, SRF, UPL, Navin Fluorine, all of them amongst the top gainers. PI Industry clearly outperforming, also had seen the significant amount of follow. Lastly, auto angs, although there's not been relief per se for the entire space, especially in the auto pack. What we are seeing today is a bit of a rebound. M&M, one of the top gainers as far as the Nifty is concerned. And lastly, on the negative side, Muthoot Finance, we did get a sense of it day for yesterday, that there could be tightened norms as far as gold finance lending is concerned. But Muthoot Finance today, the back of slew of downgrades, has actually seen intensified sell-off even after the sell-off we saw the day before. The back of that, gold finance companies, Muthoot, top laggard today.
Indeed, Ambit has a sell. Kotak Institutional Equities has downgraded it. Lots of brokerages sounding the alarm bells on Muthoot. But let's talk about the stock of the day, and that's TCS. While you're not seeing too much of a reaction, but bear in mind, TCS share price has already fallen 20% from the beginning of the year. Now, Q4 numbers were subdued. There was a modest miss on the company's top line. Margins contracted more than what the street would have liked. So the company's top line has declined in Q4 by 0.8% on a sequential basis. Margins are a bit of a worry. Margins have come in at 24.2%, 30 basis points down quarter-on-quarter. Year-on-year, margins are down 180 basis points. You know what the street would have hoped for? Margin expansion. Because if you remember, TCS, the whole year was getting a lot of revenue from BSNL. BSNL was seen as a low-margin deal for TCS. But now the incremental revenue contribution of BSNL is coming down. So therefore, that should have boosted margins, but that has not played out despite there also being a rupee appreciation. So the street is a bit concerned about the margin performance. That said, the macro uncertainty weighed. We had a chat with the management. We did that interview. They said the decision-making cycle has started slowing down since the month of February, which impacted growth in Q4. They've seen some sporadic, project delays, decision-making delays, but there is no major ramp down or project cancellation or even tightening of the budgets. The company also said that they believe FY26 will be better than FY25, at least for the major markets. And last year, according to estimates, the major markets grew 1.2%. But due to the uncertain environment, the company will decide on the wage hikes. If they're not giving wage hikes effective 1st of April, as they always do, the company will decide on that. Now, UBS says the company is currently, TCS share price is now 9% below its long-term multiple. There is comfort on valuations, which is why they have a buy call. Ambit, on the other hand, believes that the current market price is still very expensive because Ambit says the current market price, prices in an 8% top-line growth. And we all know companies and analysts expecting 2-3% kind of a top-line growth. So, Ambit has a sell call on TCS. Jefferies has a hold, and they're expecting only a 2% revenue growth for the company from FY25 to FY27. JP Morgan also neutral. They're saying that, because there will be a lower contribution from BSNL. FY26 growth will be affected, and therefore, TCS will underperform peers like Infosys and HCL Tech. But the company has a very strong capital allocation policy, and that will be supportive, especially in a low interest rate environment. So therefore, investors could flock for safety to TCS. So mixed picture, JPM is got a neutral call on the stock. In fact, we will, get to... Okay, we will slip into a very short break on that note. We'll come back and talk commodities. Stay tuned. Don't go anywhere.
Welcome back to Trading Hour. Well, some sobering news on the screen. We have the AMFI data, or the mutual fund data. This is for the month of March, which is the last month of FY25. And on account of the significant volatility that we saw in the equity indices, there's been a clear moderation as far as flows are concerned. We are seeing moderation across all of the key fund launches. So if you're looking at the net equity inflow, that's cooled off significantly at a little over 25,000 crore versus over 29,241 crore. This is on a month-on-month basis that we are seeing the moderation. The total AUM at 65.74 lakh crore versus 64.73. So there's been an uptick as far as the AUM is concerned, but that takes into account all of the fund categories. Large cap fund inflow has cooled off significantly, close to 2,480 crore versus around 2,800 crore on a month-on-month basis. So again, significant moderation over there. Net equity inflow, like we just mentioned, that's cooled off. Even the mid-cap and small-cap inflows have cooled off. Rima, this is something that we were anticipating, given the fact that in this particular month, the equity markets had cooled off quite significantly. And generally, we see when there is a significant correction as far as markets are concerned, you do see a moderation of flows. And this is something. What will be most important to watch out for will be the SIP number. That will come out a little later on the call.
Indeed. So these are the numbers as of now. The total equity inflow has come in at about 25,000 crore rupees, lower than the 29,000 crore in the month of Feb, which had already seen a correction of 25% compared to the high of about 40,000 in the month of January. So for 2 consecutive months, we have seen the total equity inflows dip. It was about 40,000 in the month of December and January. It dropped to 29,000 in the month of February, and it's further come down by 15% in the month of March. February anyway has lower days. Plus, we've seen the market, correct significantly. In March, markets had rebounded. And yet you can see, the equity inflows. But there was so much uncertainty surrounding Trump tariffs. You didn't know which way it's going. Plus, it's year-end. You could have a lot of tax adjustments that you would have liked to do as well. Large caps have seen a bit of a drop. Mid caps have been stable month on month. Small caps have seen a pickup in terms of the inflows. Surjana Borthakur of Mirae Asset Investment Managers is now with us to react to the numbers. Thank you. Suranjana, thank you for joining in. Give us your initial take. Is it a bit disappointing, or is it par for the course?
Hi, good afternoon. I think if you see in terms of the numbers, it's not a very significant drop, I would say. I think the volatility in the market has been quite dramatic. I would say, in the last month also, if you see, there has been a lot of volatility through the market. But if you see in terms of the total flows, like you mentioned, I think from 40,000 about 2 months back, it had already dropped to about 29,000. But now a 25,000 number is, I would say, not a very significant drop. What is good to see is, I think, while large cap category, there has been a little bit of a drop. I think there continues to be inflows in the small cap category. I would think hopefully the investors are investing for the long term and not taking a call on near-term returns. I think also the fact that the hybrid flows have, I think, dropped quite significantly. That is what is a little worrying, because from 6,800 to somewhere around 940 crores or so, which is a large drop, I would say. In fact, in these volatile markets, if we see, it is actually best to stay invested in also hybrid categories, because they would help investors to ride these waves. Hybrid categories within hybrid, there are a lot of options, but I think it gives an opportunity to be able to manage the emotions of investors also, because as movement of market happens, I think changes within the different asset classes happens at the fund level. Therefore, even the taxation, is very limited to the investor. It is actually at the fund side. So, which is where I think that's where maybe the concern is more. The equity, I don't see a very large drop. Looking at the scenario in the market, I think looking at what has been happening in the last few days also, there will be some amount of, impact on the inflows, and which is what I get to see here.
Thanks so much for that, Suranjana. Well, we are also joined by Anthony Heredia, MD and CEO of Mahindra Manu Mutual Fund. Thank you so much, Anthony, for joining us. What is your first take as far as the month of March is concerned? Is the moderation in inflow along expected lines? Any one-off factors? And what is the typical year-end impact that we see on ULIP flows?
Hi. No, so it's not a surprise. That's my first comment. Having said that, I think if you read beyond the numbers, I see a couple of things. One, I think clearly investor preferences are moving towards large cap. I don't see it only in context of large cap fund inflows. If you add up the flows into flexi, multi, large and mid and large, that's about 55 to 60% of the net flows, right? So I haven't seen that as a trend for close to, I would say, 18 months now. So to me, investors are clearly biasing to some degree towards large cap, which I don't think is a bad thing given relative valuations. Two, the fancy for sectoral and thematic clearly seems to have died. I see the net flow numbers here reflecting that. Three, which is a bit of a surprise to me, if we are talking about investors being a little wary, I find it surprising that we've seen net outflows in the equity savings category, which is the one hybrid category with the least net equity exposure. You would think that if people were wary on equity savings would get relatively more money than aggressive hybrid or multi-asset, but that doesn't seem to be the case. So that's the one data point that I find a bit puzzling, but otherwise, I don't think we would be too concerned with the flows. It's on expected lines. The fact that people are choosing more diversified, large cap tilted portfolios is again not a surprise. And I would expect this kind of a flow situation to remain. I am actually very encouraged by the fact that we continue to see close to 26,000 crores in SIPs continuing in the month of March. I think it's a reflection of the maturity of the retail investor. And that's, I think, my biggest source of encouragement. So that would be my initial comments.
Can you give us some indication, Anthony, of what the first 10 days of April have been like? We've seen so much yo-yo, tariffs on, tariffs off. What have you, at your fund, at Mahindra Manulife, what has been the behavior of retail investors now looking at April?
So again, surprising to me, slightly better than March. The last few times we saw sharp drops in the market on a day basis, for the first time I saw investors not necessarily coming in and buying in droves. At least that was my experience in the last 6 months, and I was a little perturbed by that. But for example, on April 3rd, for us, at least was our best inflow day for perhaps the last 5 months. It's kind of tapered off, but to me, the first 10 days of April, both from a net flow perspective and an SIP perspective, is actually marginally better than the month of March. I'll say this though. You got to caveat it for the fact that SIP flows, which tend to be a significant portion, come much more in the first 10 days of a month. So my expectation is at this juncture, April looks to be similar to March is my read.
Okay, Anthony, so April looking very similar to March. So again, maybe a month of moderation is what we could see. Suranjana, what we are now used to is seeing monthly SIP inflows in excess of 25,000 crore. What would be the number you would be looking for, especially if you take into account the kind of volatility that you're seeing? Above what number will there be no panic? And do you feel that, especially with the kind of environment that we've seen, sectoral thematic funds are definitely behind us?
Very rightly said. I think I also agree with Anthony, the fact that there was this whole craze around sectoral products and where, a lot of new products were getting launched. And last month, we actually saw that in spite of like 7 NFOs that happened, the inflow in this category had gone down significantly. I think somewhere around 2,800 crores happened in this category. But so, which is through the NFO route. So I think that craze for a new product and a differentiated product is somewhere people are realizing that the volatility in the market does not play well when you beef up too much of volatile products as a core part of your portfolio. I think it is also the SIP flows. If you look at it, I think if it remains above 25,000, I think last month there was a 400 crore drop that happened in the book, but that was largely to do with February being a shorter month. I think the fact that this month is a complete month, possibly the number above 25,000 would be okay number to look at. And I think if we continue to see this trend, we see a significant upside from about a couple of years ago. So which is where even if you look at 1 year ago, the numbers, I think they have come up very strongly. This shows the long-term commitment of the retail investor. And like Anthony was mentioning, I think even in this month, if we see in terms of corrections, one of the things which actually shows us also the maturity of investors is, I think, on very volatile days, we see our ETF trading going up very significantly. So whenever there is a large drop in the market, we see quite a significant upside in terms of volumes that are traded. So which is where I think, and this is not only to do with the, major benchmark products, it is also to do with differentiated products. So I think the buying on dips is something that is being taken a little more seriously, and any investor who has a long-term commitment is willing to stay the entire ride, is what we assume.
Thank you very much, both of you, for joining in. We need to get into a very short break. On the other side, we're going to address another important issue. We'll get an update on the microfinance industry. Alok Misra will join in on the other side to gauge what FY26 looks like and whether we are seeing any improvement. Welcome back. As promised, let's talk commodities, and we're focusing on precious metals. Manisha is now joining in. Manisha.
Thank you for that, Rima. Well, very, very strong gains coming in for gold and silver both. When you look at this week, we are looking at 5 to 6% of gains coming for gold and silver both. But the big story clearly is in gold, where we are trading at an all-time highs in various major currencies. In US dollar terms, we've seen $30 to $20 an ounce take on the higher side. And with these gains, we are now for this year up by 23%, even as we are still in the first half of this year. This is in comparison to last year's gains, where we saw gold prices gain up by 28% as well. So very strong gains coming in, as I said, in dollar terms, in rupee, in Japanese yen, in Chinese yuan, Australian dollars, euro, various currencies. Gold prices are trading at an all-time highs as we speak. Well, it is about safe haven buying amid US and China warring with tariffs there. And that really tells the market that with two major global economies putting tariff missiles at each other, it perhaps could lead to weakening in different other economic markets. And it could also lead to inflation, even stagflation in US for that matter. And that has been supportive. The other factor is about the US dollar index, which is trading near 3-year lows. We've seen 100 reach at one point in time as well, and that has been supportive. The markets also are anticipating more stimulus measures to come in from China, and that in turn has been supportive for metals. This is where the silver prices also seem to be gaining strength from. I want to bring on your charts on what we've done in this week in sense of gold and silver prices. While gold is up nearly 5.5%, silver has gained 6% in this its week till time. If you look at the past 12 months, then gold clearly outperforming silver there with gains of 38%, while silver is up 13% at this point in time. I also recently spoke to Jörg Keener, and he is very bullish on gold, says that 3,300 is what you could be looking at. But important level coming in from Jörg is about $8,000 an ounce of a possibility in next 5 years or so.
I think that the trend will continue to go up and accelerate. And when I mean acceleration into July, I think you could easily see somewhere between 3, 5 and a few $100s above that for this year. And probably prices in the tune of $5,000 to $8,000 in the next couple of years. real mismatch on the West versus East. We see as well huge spreads. So you could actually sell silver into China at $3 spread. I think in the low 30s is a great time to buy, and you want to be testing at least the $50 mark, which is basically would be a triple top in the short term, and then we'll see where we go thereafter. But I think that's about the trading range, $30 to $50 for probably the foreseeable future.
Well, that's the view coming in as far as the precious metal market is concerned. But moving on, Mitesh Nakkar now joins in for a quick technical check on the market. Mitesh, it's been a very strong Friday start that we have seen. Do you think markets can sustain at current levels? Do you feel that there is now a bottom in place, definitely, at least as far as the Nifty is concerned?
So, I don't have a confirmation of a bottom being made yet, but I think it will sustain for the simple reason that we're getting past 22,850, which in the near term was an important pivot. I think the way we're showing strength suggests that this bounce back might even extend about 23,050, 23,100 zones. So I think stay positive. And only if it starts breaking below 22,700 would I start getting worried, and we might then come back into the zone. But in the immediate term, which is about next couple of days, it looks like there's a higher chance of us getting towards 23,050 to about 23,100.
Got that. What about stocks? Anything that you have on your radar?
Yeah. So I have a buy on Kotak Bank. I think, that's a stock which has bounced back very well today. Kotak Bank is a buy with a stop at about 2,100 for targets of around 2,200. We may eventually look at higher levels, but that's the near-term target. And on the other side, I also have a buy on Hudco with a stop at about 213 for targets of 225.
Thank you so much, Mitesh, for joining us, giving us a view on the market as well as your individual trading bets. But it's now time for a short break. Alok Mishra from Microfinance Industry Network will join us next. Welcome back to Trading Hour. Well, let's now shift our focus to the microfinance sector. In a recent report, brokerage firm Investec said that the current cycle of Indian microfinance appears to be approaching its conclusion. It added that asset quality indicators have started showing improvement across various MFIs. They also expect the recovery to be gradual, leading to consolidation within the sector. To discuss more on this, we are joined by Alok Mishra, CEO and Director, Microfinance Industry Network. Thank you so much, Mr. Mishra, for joining us. First up, finally it appears as though some of the dark clouds are spreading. What's the on-ground trend as far as the MFI space is concerned? Has there been marked improvement as far as collections are concerned?
Thanks for having me here, and apologies for a bad throat, first of all. Well, I fully agree with what the report has read, but not what full part of the report. I think the dark clouds, I had spoken on this so for many times, and I have always said that these are not dark clouds. These are temporary blips which happen due to a host of circumstances and not due to only microfinance, which had happened. But yes, it is correct. If we look at the credit data, I am not talking about individual companies, but about the sector data. And the last data available to us is of February, while listed companies have also given data in public domain of March. From October onward, it peaked the credit quality, whether you see in terms of 1 to 30 days or 30 to 90. It peaked in October. Since then, we are seeing a gradual reduction. We saw it in month of November, in December, in January, as well as in February. So yes, the credit quality is getting better. And the loans which are being disbursed currently are showing much better portfolio quality.
So, Mr. Mishra, how much better is February, the data that we have, versus October, which was the worst in terms of asset quality?
Yeah, so I will tell you if I take a measure of PAR 1 to 90 days, anything below NPA, in October it was 5.38%. In February, it has come to 4.65%. So that's, you can say, nearly 80 basis points reduction. And within that bracket, 1 to 30 days, 31 to 60 days, there are different measures. But overall, in 1 to 90 days, there has been a steady decline. And it is a gradual decline. And let me also tell you, because many times we forget that, that these numbers, if it would have been a normal year, these numbers would have looked completely different. What you're seeing as 4.7, that would have maybe looked at 3.5. This is because of what we call as the denominator impact, because in the last year, that is 24-25, the disbursements have been slow. And as we know, that in March, the sector had a portfolio outstanding of 4,33,000 crores. But now when we are sitting in April, but I have the data for February, the sector shrunk by 15%. So when you take out the portfolio quality, any portfolio quality, number of loans which have overdue, say 1 to 30 days, you divide it by entire portfolio, the portfolio has not grown that much, or rather it has shrunk. So these numbers seem to be elevated. But in actually, if it would have been a normal year, they would have been even seen as much lower.
We get that point completely, Mr. Mishra. Mr. Mishra, the other significant problem that's been highlighted by industry and especially by players with exposure to the state of Karnataka has been the significant guardrails that have been imposed and also restrictions in terms of actual collection. So Karnataka, what is the on-ground situation? When do you see that improving? Will players, with higher exposure to Karnataka, wait for a longer period of time to actually see a bit of recovery?
Yeah. So first of all, Vivek, let me clarify that guardrails have nothing to do with Karnataka. They are pan-India.
Right.
And they were announced way back in November, and when the Karnataka thing started in January. Now coming to the Karnataka situation, while we saw a small uptick in the months of February, but now from March onwards, what the field reports I get, because see, one is the data which the institutions have reported. One of the large NBFC MFI, which has a significant presence in Karnataka, has already reported the data. Data is in public domain. It shows things are stabilizing, nothing to worry. And we also keep a tab on the field incidences and also have a close connect with the government. Things are smoothing out. We don't see any major hiccups. And I think Karnataka should be back to normal in next 1 to 2 months.
Mr. Mishra, the recovery it's been gradual and it's not broad-based. There would still be players who are struggling. Some have improved, the performance has been better than others. In the coming year, in FY26, do you see consolidation opportunities, some M&As taking place?
Well, as in head of SRO and industry body, I would not like to comment on consolidation. I would leave it to the market forces. I can only say I don't see any policy imperative or any, you can say, the pressing factor in the domain of ecosystem, which is pressing towards mergers and acquisition. But if two companies decide to come together to bring the synergies together, is the individual company's choice.
Mr. Mishra, you briefly alluded to guardrails 2.0 that has been put for the MFI space. FY26 onwards, how will that impact the industry? Do you see any concerns as far as growth is concerned? And also your view on over-leveraging by customers. That has been something that has been constantly flagged off by the regulator.
Yeah, I think, Vivek, give me some time. I've clarified 1 or 2 points here.
Sure.
One is that the guardrails, the first guardrail which was introduced in July, July and August last year, wherein we said that it should not be more than 4 microfinance lenders. And now from 1st April onwards, with a due notice of 4 months, we have reduced it to 3 lenders. And the results which we see is improved credit discipline. And it would be too early to say that the improved credit quality is the result of the guardrails, that I would not hazard to say so. But what we hear from the field that it is imposing discipline and the underwriting and the money supply becoming a little scarcer. So the credit quality is getting better. Discipline is returning back. So that's a good point. But on the side of over leveraging, I think in the last year, when your chips are down, when the credit quality went a little poorer compared to what microfinance generally has, there were a host of reasons beyond that, and we have elaborated on it in various forums, whether it was the heat wave or it was the stagnant rural wages, but everything was put as if the sector has over-indebted. But the real situation is that even if we have put a strict condition that not more than 4 microfinance lenders, the number of clients which have more than 4 microfinance lenders is only 3.2%. So that's not much. It will not have a major impact. And let me also say that now what we are witnessing a situation wherein all these borrowers are increasingly having retail overlap. So while retail, even if we do all the best from microfinance side, if some retail player comes and lends a retail loan, then the whole discipline goes down. Our space is shrinking, and that is why in our guardrails we have also said a maximum cap of indebtedness to a borrower of 2 lakh rupees. That is in addition to the lender cap. And we have said that that 2 lakh will also include unsecured retail loans. So our space may be shrinking because of other players, and they might be over leveraging the client. But we are trying to emphasize on the discipline, even if it reduces the space for microfinance.
Thank you so much for joining us, Mr. Mishra, giving us a view on quite a whole host of details regarding the MFI space. We'll get you back on the channel soon. Well, we'll now take a short break. Up next, we'll discuss market fundamentals with Anirudh Garg of Investec PMS.
Welcome back. As promised, let's invite Anirudh Garg on the show now. He's from Inva Asset PMS. Anirudh, thank you very much for joining in. We just saw the mutual fund data for the month of March, and despite the rebound, the inflows into equities have fallen by 14-15% compared to February, which was anyway a very tough month. What are you all doing at Inva Asset PMS? Have you all also retreated from investing in the market? And do you think this rebound that we're seeing today is sustainable? What's the advice now, and what are you doing with your portfolio?
Good morning, and thank you for having me. I think we at Invasset PMS focus a lot on the behavioral finance part of the market. And we feel that, as I mentioned last time on your program as well, that we are now very bullish on the markets. The only fear that we have right now is that if it is only about tariffs, then it's okay. Things will be all right. I think the market may have even bottomed out. But sometimes what happens is that a systemic risk sometimes gets, gift wrapped in some other situation, and the things are avoided. And America, if we see, has been at the forefront of it every time. So we are not predicting any bear market from here, but we are being cautious also, though fully invested.
Understood that. Anirudh, I believe this indicates a very marked change as far as your own stance is concerned. Last time we spoke to you, you're sitting on very high levels of cash. So what actually has triggered the change? Is it mainly on the back of the fact that the market correction has made valuations very palatable?
Yeah, absolutely. So there are 2 points. When we sold off, we were one of the only funds in India who went to 100% cash. The reason that time was that the valuations were expensive, and there was too much greed in the market. The exuberancy could be clearly seen if you wanted it to see it. And now, on the other hand, the valuations are better. You're getting your portfolios 35-40% below. Even the mid-cap index is around 25-26% lower. So the valuations are right. And as you mentioned, since the mutual funds SIPs have stopped and the numbers are going down, this clearly indicates that there is fear in the market, or there is uncertainty. And if we see majority of the bull runs, be it COVID, post-COVID, or post-Russia-Ukraine war, majority of the bull runs, they stem from a period of chaos. So we are very, very optimistic on the market. But on the same side, we are maintaining a cautious stand as well, that if something bigger turns out to be, we are ready for that.
What about technology? Technology has been the rank underperformer. And now some stocks like Infy, TCS are trading below their long-term average multiples. That said, so where do you stand on tech, especially the large cap names?
Yeah, so you're absolutely right here. Tech in the last 1.5 months has taken a beating, which has brought down the valuations at very, very mouth-watering levels. But we do not hold anything in tech now. We buy value only when we believe that, firstly, there is overall in the value in the market. So this is the right time to buy value. But we should see, consistency or visibility of earnings for the next 2 to 3 years. And primarily we want the rates to be higher, the rate of growth to be higher. That is why we are not, holding a large position. Barring a couple of stocks in the mid cap tech, we are not holding any positions in tech because that is the lack of growth is the only reason we feel that we do not venture into the ground. But if you look at value, I think large cap IT is surely, as you rightly said, there is value in the large cap IT now.
Anirudh, we want your views on two specific sectors. The first one has to be the pharma pack, has sold off significantly. There are still worries of impending tariffs, but are valuations now impending? And would you take a view on whether or not tariffs, especially for Indian generic makers, will be applicable? And secondly, one space that's doing very well is chemicals. Again, a sector that saw significant sell-off in recent times. So would you like that space as well?
I think I like both these spaces. I like pharma. Pharma is our top bet. So we would say around 20 to 25% of a portfolio is now pharmaceuticals because we see that growth factor there. Though we focus more on the CDMO and CMO part of the market, where we feel that growth and relative change will both be very strong for the next couple of years. The point here right now is that we have to ignore these noises of what the tariffs will be. How Donald Trump will react, I think nobody in the world knows about it. What is his purpose? What is he doing? What are the strategy? Rather than focusing on all these noise, we should focus on where the fundamentals of the companies are and where relative change can be strong. So pharma, I think, is very, very nice. And you rightly mentioned chemicals as well. We are seeing strong tailwinds for chemical sector as well. And I think for the next couple of years, it should be a medium to good sector to invest in, chemicals. But pharma, we are very bullish.
In chemicals, could you give us some more color on what you like? What should investors look at?
So we are not holding very significant positions in chemicals because they're not reached our top 25 to invest in because we are finding better opportunities. But yes, I think if somebody is holding positions in the chemical sector, and I think all of them, primarily, this is a time where you have to be with the leaders. So if you know your company is a leader in a particular type or particular segment of chemicals, then I think it is right to hold on to them. I think the last 2 years, which were not very, very great for chemicals, the next couple of years should be better.
Anirudh, one clear avoid you mentioned is, or one clear cautious stance is the IT pack. FMCG, are you cautious there? Would you turn buyers at current levels?
No. So again, FMCG for us, we go to FMCG only when we need to be in a defensive space. Okay. But okay, again, the relative change for FMCG is very strong. 1.2 lakh crores coming in the hands of the Indian consumer. And then, inflation getting better, the prices softening. And overall, I believe that FMCG, as it has underperformed, again, like chemicals, as it has underperformed the last couple of years, should not underperform for here. But again, we're not holding a lot of positions in FMCG. On the other hand, we are focusing on newer market segments where growth rates can be higher in the consumption sector as well. Consumption is a number 3 bet, but again, some better companies here rather than the old traditional FMCGs.
Okay, and any view on quick commerce? Any view on as far as the new age tech companies are concerned?
I think new age tech companies should be all right. Especially delivery platforms and all these new age companies still have a room to grow. They still, I believe the valuations are not that high, especially after this fall, the valuations have corrected and I think they are okay to invest in. We like the new age companies now.
Thank you so much, Anirudh, for joining us, giving us your view on a whole host of markets and a marked change as far as your own stance is concerned from being quite cash heavy to aggressively deploying across the market is something that we've noticed. Well, it's now time for a short break. We'll get you more on the markets on the other side. Welcome back to Trading Hour. Well, the strength in the market is continuing. The Nifty is now up well over 2%. Have a look at the mid-cap index, again over 2% higher, and the small-cap index 2.5% higher. Significant buying has emerged and continuing even over the last hour. But one particular sector that's doing very well is the chemical space, and within that, PI Industries is surging. This is after Donald Trump announced a 90-day pause on tariffs. Vamakshi is here with more details.
Well, Vivek, absolutely. PI Industries is surging in trade, up almost 7% now. The US put a 90-day pause on reciprocal tariffs. As we all know, the tariffs now stand reduced to 10% temporarily from 36% that they had, sort of disclosed earlier. Keep in mind that when the reciprocal tariffs were announced, in the next 2 sessions, PI Industries dipped by almost 6%. But today we're seeing a recovery that is mainly on account of the 90-day pause that has come in from the US. Keep in mind the current order book for the company stands at around $1.4 billion US dollars. The exports as a contributor to the overall revenue stands at 83%. So PI Industries is heavily focused towards exports, and within exports itself, the revenue contribution from North America as of FY24 stood at 44%. So North America itself is a significant contributor as far as PI Industries is concerned. So therefore, earlier on when the 26% tariff was imposed, there was a note that came in from Jefferies as well, and they said that if 50% of the tariffs were absorbed, there would still be an EBITDA impact of almost 6% for PI Industries. With the 90-day pause now coming in, this immediate overhang of the impact on PI Industries actually goes away, and therefore the stock is seeing a strong rebound today.
Thank you very much for that. Let's now find out Muthoot Finance stock is under pressure. Ritu joins in with more on the gold loan regulations that have come through. Ritu.
Well, thanks for that, Reema. Muthoot, as you know, it has almost 95% of its AUM in gold loans, and therefore you're seeing the kind of reaction you're seeing on the stock. The big takeaway from the draft rules really is that they're not as bad as they were feared to be, but in the short term, there could be some impact on those gold loan lenders. Now, what the draft rules really say is, one, for bullet consumption loans, the tenor has now been capped at 12%. They also say gold has to be valued at 22 carat purity only. The loan to value ratio, now it remains capped at 75%, but here's the change. Earlier, this ratio had to be maintained throughout the tenor of the loans for banks only, and now it is going to be applicable to NBFCs as well. Now, for bullet repayment loans, RBI says the LTV will have to be calculated on the total amount, which means interest that is accrued at the end of the tenor of the loan along with the principal, and that means the origination LTV may decline because lenders will now have to build in these buffers. Apart from this, if the LTV ratio breach continues for more than 30 days, there will be 1% additional standard asset provisioning. So in summary, some of the arbitrage that existed between banks and NBFCs will be reduced if these draft norms are implemented, and therefore you're seeing some of the reaction in the stocks. If you look at the brokerage views, they see that it could affect loan growth in the year immediately after implementation. And Morgan Stanley, for instance, says Muthoot's business is still stronger compared to some of the other NBFCs, and they're building in an ROE of 20% in this financial year, 18% in the next, even if AUM growth is flat. Jefferies believes this could impact growth and provisioning generally for gold loan lenders, and CLSA believes this is marginally disruptive for the likes of Muthoot and Manappuram, and they're building in about 12 to 15% loan growth in the next couple of years.
Thank you so much, Ritu, for joining in and taking us through the draft guidelines that RBI has put out as far as gold loan financiers are concerned. But another stock that is in focus today is Tata Steel. This on the back of development as far as its Netherlands unit is concerned. Nigel joins in to tell us more.
Well, that's right. Tata Steel has said that they are taken on a transformational change at their Tata Steel Netherlands operations. And they believe that they're looking at making this particular unit one of the most profitable and cost-efficient units as well. So what have they stated? The management has estimated that by the second half of FY26, they are looking at a annual savings of close to around 500 million euros, which goes up by another 50 million euros in the following year, which totals close to around 550 million euros of savings at Tata Steel Netherlands by FY27 itself. Investec, they say that this translates to a cost saving of roughly around $80 on a per ton basis. Remember, in percentage terms, it constitutes close to around 15% of the total controllable cost. How do they come about this number of around 550 million euros? Well, a third of it will come in from cutting jobs at their Netherlands facility. As of now, they have around 12,000 employees. They are saying that they'll cut close to around 1,600 jobs. So a third of these savings will come in just by this. The other factors that they're looking at is improving volumes, product mix, better efficiency of the blast furnace, and also higher utilization of pellets, which in turn will help their profitability. So that's the broad breakup. Now, besides this measure, they also made two other important points. One is that the direct impact of the US tariffs is very, very limited on their operations. Point number one. Point number 2 is they say by second quarter of this fiscal, that's FY26, the UK business will turn cash break-even, which is very, very positive in itself. What are brokerages saying? Phillip Capital, they have a buy rating. Target price they placed at around 173. Earlier, they were working with Tata Steel Netherlands, having a profitability of around $40 to around $60 on a per ton basis of EBITDA. However, they are saying that the proposed plan now will save cost. And that's why they're looking at an additional benefit of around $80 in FY26, which goes up by another $7 in the following year. Investec, they have upgraded the stock to hold from a sell earlier. They say that Tata Steel Netherlands now has the capability to do $100 on a per ton basis, and they are considering only 60% of what they said in terms of savings. They also say that risk that Tata Steel India will have to support the Netherlands business, that goes out of the way, which is another positive. Put this together, Tata Steel is rallying in today's trading session.
Thank you very much for that. And not just Tata Steel, Pharma is higher today, Sun Pharma and Cipla in particular. Vinny is here to tell us why the street is so excited.
Hi, so yes, both these stocks surely are in focus today. Now, Sun Pharma, positive news flow coming in. If you remember, in November 2024, there was a preliminary injection that came in, injunction, I beg your pardon, that came in for Lexelvi, which was an important drug for the company. Now, this was something that was a court case that was going on with the innovator of the company. Now, just yesterday, what we got to know is the US Court of Appeals for Federal Circuit has ruled in favor of Sun Pharma. So, this injunction that was there has been lifted. That means they can now launch Lexelvi. Now, the company has mentioned in their press release that Lexelvi launch time, they will inform us as and when in the due course. But what analysts are expecting is that this could come in sooner. They're expected next few weeks is when we could see the launch coming in. Earlier, the anticipation was around Q4 FY27 because the patent was expiring in December 2026. This is a big positive for the company is what UBS has highlighted, especially in terms of margin expansion for the company, as well as in terms of peak sales that are expected from this drug could be somewhere around $400 to $500 million is what UBS has highlighted, with an EBITDA at around 50%. So Sun Pharma surely is in focus and seeing a bit of an upside. Cipla too, positive news flow is coming in as they have received a US FDA approval for their generic Braxin. Now, this is used for the treatment of breast cancer, also some other kind of small cell lung cancers as well. So different cancer treatments is what this one is related to. The product was expected to be launched somewhere around in the first half of FY26. Now that has come in second half of FY26. Now it's launched sooner, and that is why a positive sign there. Elara has already penciled in a $20 million revenue coming in for FY26 from this one, and it could also gain as much as $50 million from this drug going forward as well.
Thank you so much, Vinny, for joining us and giving us all of the updates as far as the pharma pack is concerned, a clear outperformer in today's trading session. Well, with that, it's a wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.